Hello, everyone. It's Try here for my second episode of Try's World. I may rename it, but right now I'm going to keep it Try's World. Um, I wanted to thank everybody for tuning in and to my first episode and watching on either on YouTube or Spotify. I started this to try to help folks, and I'm glad it's helping some people or speaking to some people because they're tuning in and I definitely appreciate it. So thank you. Please continue to subscribe. Please continue to like and follow on Spotify. Subscribe on YouTube. I know it's been a while since my last podcast. These are more time consuming than I thought they'd be. It's been busy also with earnings season. We're in the middle of earnings season right now. So I've been very busy. I did receive a lot of feedback. The ones that I'm most interested in and most focused on, though, are questions that people are curious about. And that's a lot of the reason why I started the podcast, is to answer a lot of questions that people may have, things that I've heard a lot of, and I feel like I may be able to add, I may be able to help in terms of adding some expertise or some of my opinion based on my experience, which corrections and amplifications from my previous podcast. I don't have 5 years of formal investment experience. It's 4 years of formal investment experience. And so I did want to clarify that. And that has more to do with formal stock investing experience, stocks and bonds, money management for big money management firms. I did invest in real estate for many years before I started managing money as well. And one person wanted me to talk about inflation and how to stay ahead of inflation. I think it's a great topic in terms of we're seeing our money lose value, our dollar lose value. If the most basic way to explain it is, if inflation is running at 4% or 3%, and you're getting a return, a nominal, they call it a nominal return on an investment of 6%. Inflation's running 4%, your real return is 2%. And so when people keep talking about how high interest rates are on cash, which are T-bills, let's just say, T-bills are 4 or 5% right now. Short-term T-bills, they're basically maturity of less than a year, government securities. And if inflation is running at 3%, though, 4%, 2%, the point is your real yield may be like 2% or 3%, and that's not really a great return. It's better than before, but I wouldn't say that this is a really nice investment in comparison to stocks. And stocks, if you think about good stocks, companies that are able to raise their prices and keep up with inflation, maybe even ahead of inflation. And these are companies that have some type of franchise that can raise their prices. There are companies like that. And so you would expect stocks to stay ahead of inflation and give you a better real return after inflation. And so when people keep talking about, or I'm going to invest in cash, essentially, it's not a great investment right now, not in relation to stocks still. And it is a good place, though, to park your cash if you need that cash for a rainy day fund, whatever it is. Most people buy bank CDs. I like to what I call roll T-bills. It's called rolling T-bills because every time it matures, you buy another T-bill to replace it. And most people wouldn't guess this, but that's probably Warren's second largest investment right now is in T-bills. And people are missing out if they don't look at that as a way to stay ahead of inflation, because let's just say you have a pile of cash for whatever reason and you leave it in the bank. Most people end up doing a lot more harm to themselves than good by saying, I need to move this cash to an investment, because they end up putting it in an investment or rushing into an investment that actually loses value. And so you probably would have been better off in cash. I don't think people, if they have cash, should be rushing to any investment. I've talked about my favorite investment, which is an index fund, an S&P 500 index fund. And I did say, hey, I'll talk about how to actually invest in one, and the mechanics of it, which I'll go into. But I did want to talk about T-bills first. And for cash, you might want to do a CD or a T-bill. I like T-bills. You could buy T-bills on your brokerage platform if you have trading permissions in fixed income. If you trade a fixed income, many times your brokerage will let you trade T-bills, and you can go into your brokerage and look for fixed income, look for T-bills or government securities, and select T-bills or maturities of less than 1 year, and you can see, at least in your brokerage, T-bills trading on the secondary market, meaning they're not issued by the government themselves, which you can buy on treasurydirect.gov if you want to roll T-bills. I've done that as well, and it's very nice. It's just, if you want to sell one of your T-bills before maturity, which T-bills, you can, what they call ladder the T-bill, which you could buy 3, 6, 9-month T-bill. But if you buy a 9-month T-bill, you need it ahead of time. It's really difficult to do that on treasurydirect.gov, because you have to then get that T-bill to a brokerage anyway, and then sell it out of the brokerage, which I think is too troublesome for most people to do. If you're a smaller investor, there is a liquidity issue if you invest in a 9-month T-bill on Treasury Direct, or you buy a T-bill directly from the government. If you buy it on the secondary market through an online brokerage, you can essentially buy T-bills on the secondary market, buy it, and then for any reason sell it without a prepayment penalty like a CD would hit you with, right? So there's ways to do that with your online brokerage, and there's some good tutorials out there to show you how. I would recommend is just mark on your calendars a reminder of when your treasury bill is going to roll off, and you can go in and reinvest it. So you can make sure you get whatever your 5 or 4%, whatever it's paying right now, and it's around there, which is not bad. The thing about treasurydirect.gov that I like is it reinvests it for you. But if you don't want to spend a lot of time rolling T-bills, you don't have to buy really, really short-term T-bills. Like, there are 1-month T-bills. You don't have to roll it every month. You can buy 3-month or 6-month and just set a reminder for semi-annual rolling of the T-bill. But obviously 6 months is a long time, so you don't really want to invest a large chunk of your cash in there at Treasury Direct. You can't sell out of it. So you really have to look at your own situation and figure out how much cash you want to invest in T-bills. I like the secondary market, even though I don't get as much yield from the secondary market, but I do like the liquidity, at least as an individual rolling T-bills. And this goes back to indexing and how much you should invest if you're going to invest in stocks. And if you do that, it's generally recommended in terms of for retirement. You save 10% of your income every year. You invest it. If you're investing in an index fund, a lot of companies have a program where you can invest a certain percentage of your paycheck every month or bi-weekly, whenever you get paid. That's what I did for a long time, and it will just contribute to that fund. If you chose it, let's say aggressive or something, I'd just double check and make sure it's not invested in like a hedge fund or something really weird. I would just double check that. And because there are ways for you to just, invest it yourself, get out of that aggressive one and invest it yourself. And then they'll have all these fund options, but you want to do an S&P 500 index fund, not some exotic fund. I mean, there's a lot of them out there, and they have all these performance measures and all this. And I can almost guarantee if you're pulling the fact sheets of most funds, they're going to be behind the S&P 500 after fees. And make sure you're comparing to the S&P 500 total return. Most fact sheets have the S&P 500 total return, but I would just make sure that dividends are included in those S&P 500 returns. If you're trying to compare fund to fund, and just because you find a hot fund, it doesn't mean it's going to continue in the future. And so I just think there's so many funds and ETFs nowadays, you can get really confused. And to keep it simple, I would buy an index fund, and I would, whether it's your 401k or anything else. And so if it is aggressive, I would just make sure the stock funds are are something you feel comfortable with. They're probably not in index funds. That's the only problem. And the bond funds likely are in an aggregate maturity fund, which just means it's got maturities from short term, medium term, long term. It's a diversified bond fund. Those are usually the bond funds that your 401ks are invested in. And yeah, I would just take a look at that. I mean, you know, I've had people pick a retirement fund. I'm going to retire at this age, and then they look in there, and it's like 40% bonds. And then you look at the bond portfolio, and it's hugely allocated to long-term bonds or short or even medium-term bonds right now, which lost a lot of value when interest rates went up. And that's what it blew people's minds when they looked at their portfolios and like, wow, I'm down. And it's because of my bond fund. And bonds are supposed to be safe, but we found out recently that they can lose principal value as well, just like stocks. And I think that's almost crazy to some people because they've always been taught bonds, 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 but at what price? And if bonds are yielding too low of a yield and interest rates are at all-time lows, it makes bonds the principal value risky. And this is what happened to banks holding bonds, and this is what caused some bank failures and runs on banks. Most recently, with Silicon Valley Bank, you either make loans on deposits or you buy assets, and the assets they were buying are bonds. And so when people find out that, hey, my deposits are invested in bonds that had just lost all their value, they get scared, rightfully so, and they go and try to withdraw their money. And if too many people do it, especially nowadays where they could just do it online, and runs on banks are quicker than ever. And so the whole banking sector's changed. And so you've seen Warren, and I like to say Warren because he's one of the most visible investors out there. He sold a lot of banks recently due to the change in not only regulations upcoming, but how fast money moves nowadays. It's changed the deposit game. I mean, it used to be you make a deposit, they're very sticky. They stay there. Now if people get spooked for whatever reason, they can move their deposits like that. They don't have to wait at a line. They don't have to talk to a teller. They don't have to, wait for the market to open. They can move it instantaneously. So that's very much changed banking, and that's what a lot of Dick Beauvais is a very prominent bank analyst who talked about that recently, and Warren's talked about it as well, and it reflects in a lot of his sales of banks recently. In terms of indexing and investing, it's money you want to have that you can keep invested for 3 to 5 years. You got to have a long-term outlook on the money you invest in stocks, because you don't really know what stocks will do in the short run. You know what they'll do in the long run, but not in the short run. And so what you want to do is invest it with the long-term mindset and money that you won't need for a long time. You don't want to invest money that you need, especially in stocks or anything, or bonds. Those are investments as well. So I would, if you can, save, again, 10% of your salary every year. That's sort of the shorthand rule, is to try to save 10% every year. If your company matches, even better. And then you consistently invest in the market, and so you'll get market returns, or your share of market returns, every year. So it really is. It shouldn't be that difficult to get market returns, but people really mess it up by trying to be too fancy with it, trying to pick their own stocks, for example. And I know I in my first podcast, I did talk about not investing in individual stocks, and I bring up some examples and things like that, and I still adhere to that. If just because you've seen a stock run up, or certain stocks run up, or AI run up, it doesn't mean you're right. You know, I mean, things can run up for a really long time, and then and still crash. And that's happened many times in the past. So just because, uh, and so what a lot of people are doing is saying, well, I hope I'm right, but if I'm wrong, I think I'll get out faster than most people. And that's what everybody else they're like, so. And I'm not calling a bubble or anything like that. I'm not saying there's a bubble. I'm not saying, anything like that. But even if the stock is overvalued, once it loses its value, a lot of people who know it's overvalued or too overvalued, they tend to think I'm going to get that last penny on it. I'm not going to sell it even though I think it's overvalued. So I'm going to keep going until I see it go down, and then, you know, so again, that's based on what other people are doing. And at least in my experience, it's a losing strategy because everybody thinks they can do that. Everybody thinks they can get in, regardless. Let's just say you're not even valuing it and you just see it go up. That's what the whole meme stock craze is pumping it up and talking about a crazy meme stock until, it starts losing value like crazy. And then, the strategy is to jump out. And to me, that's just, it's first of all unhealthy psychologically because you're really on pins and needles. And then it's not the most important thing though is it doesn't use any strategy of valuation strategy. It doesn't have any framework to hold you. You're not saying, hey, I think this is. Here's a great book. I have it right here, and I have these napkins. It's recently revised by Jason Zweig. And I already tore through some of the book. And so I tore through it so fast I didn't have time to put bookmarks. So I put paper towel napkins. And what I was really looking for was, and he did a good job, by the way. I thought he did a good job in terms of, I thought he was going to avoid talking about stocks or individual stocks altogether, but he does jump into some individual stocks. He doesn't recommend any. I don't think that's Jason's strength. But he has so much knowledge himself as a columnist for the Wall Street Journal. And by the way, both the Wall Street Journal and the New York Times agree on the tariff policy. It will be inflationary. And again, the people saying, oh, that's the institutions, that's print articles. I mean, I think we've gotten to a point where we're cynical. It's an extreme level of cynicism where you point at every institution and everything, and you're like, is that even real? It's really gotten to an extreme level where you trust no one, you trust nothing, and it's to a level where I think it's unhealthy. It's cynical. You don't believe in the good of anybody's intentions or any institution, really. And so, but both the Wall Street Journal and the New York Times rarely agree, and especially in an election season, they agree on that, is certain policies will be more inflationary. So people are worried about inflation. Tariffs aren't going to help you. Anyway, this is a great book. I did, like I said, I went through a lot of it. It does talk about Mr. Market. It does talk about margin of safety. It does talk about indexing, and how to avoid, crazy. It talks about a lot of good things, and I really do recommend it because it updates it with AI. It ups it with a lot of topics that investors are interested nowadays, and these aren't updated often. And so, what happens in these books is you get the original, and then you get Jason Zweig's commentary. And if you've already read the original text, you could just jump right to the commentary. And then if you've forgotten the text or whatever was in the text, you can go back and read the text. But it goes chapter, commentary, chapter, commentary. So I would check it out. And that's partly why I do this podcast as well, is to let you know what I'm reading, what I'm kind of paying attention to, and to turn you to some of this stuff. I mean, I find out about this stuff probably before a lot of other people because I'm always reading and trying to get the latest and greatest in terms of strategies and techniques. If you have some time, I would pick that up and read. at least the chapters on Mr. Market. I think it's 8 and 20. Those are Warren's favorite chapters, and margin of safety. It goes into defensive investor. It goes into enterprising investor for those who are more aggressive, and the criteria for those. And then again, Jason kind of goes in and updates some of that criteria, allows you to understand about it with more recent examples. So that's what Jason does. But going back to indexing, to the basics of indexing, and the first thing you need to do is if you're indexing on your own is open up an online brokerage account. That's what I would recommend. Now there's several. There's Schwab, there's Merrill Edge, there's Ally Invest. There's a bunch of these online brokerages. Some are better than others, so I would read reviews on which one makes sense to you and which ones, if you're interested in T-bills on the secondary market, will allow you to trade T-bills on the secondary market easiest, and how you can go about doing that. Again, that may require some permissions in terms of experience in order to trade fixed income at all, or you could just call them beforehand and say, hey, how can I go about trading T-bills? And again, that's for your cash section. But for indexing, you open up a brokerage, you fund the brokerage from your bank account, however much you have to invest, and that should be long-term money. And then I would do some tutorials. There's even paper trading accounts that you can, buy and sell on a paper trade account. I think Yahoo has a paper trade account. But if you're not comfortable with investing in individual securities and you want to see how you do, open up a paper trade account. It's a fake account. It's not real money, but it'll show you, it'll track your stocks. It'll allow you to buy and sell. You can track your performance and see how you do. If you feel like you're doing well, well enough, open up a real brokerage account, deposit some money, and invest. But going back to that, Jason had an article recently in the Wall Street Journal about how many people have rolled over an IRA that sits in cash. And the assumption is it's been invested. It's not simply a matter of opening up a brokerage and depositing the cash. Now you've got to invest the money. and I think there's a lot of online. YouTube is a great place. Online tutorials. It can be a weird place as well, so I'd be careful. But there's some online tutorials. But the online brokerages will have their own tutorials on how to buy and sell a stock, or how to buy and sell an ETF. And so I would look at some of those tutorials. But once you deposit your cash, there's a way you can go to the trade button. You could do trade a stock. A stock is many times the same thing as an ETF. Trade stock or ETF, and then punch in the symbol of the actual stock you want to buy or ETF you want to buy. I don't want to go into the symbols because you can Google that very easily, and what an S&P 500 ETF might look like, and there's reviews on those. So there's a lot of information out there on how to do that. But the actual mechanics of depositing the money, once you deposit it, trade the ETF. You could do a market order or a limit order. You could look up what that is. And then you could finally place the trade on your online brokerage. So you may even have a 401k plan, but you still want to do something on your own. You may open up, for whatever reason, a taxable brokerage on your own and buy ETFs on your own. For people who don't have a company 401k who's just depositing your cash and kind of doing that. But even if you have a 401k, the mechanics would be the same if you want to buy an index fund and not just whatever your company's buying for you in whatever profile you chose. If you want to invest in a bond fund, they have aggregate bond funds that sort of buy every single maturity. So most allocations, depending on how aggressive you are, your retirement, have some type of bond allocations. But if you're young, you have a long time ahead of you, and you're okay with volatility, then you may want to allocate more to stocks. And as far as bonds are concerned, though, there are bond index funds, index type funds that buy every single bond on the market. It'd work like a stock index fund. And I would just allocate the same way if you want to have a bond allocation, which on the low end, a lot of people have, let's just say 10 to 20%. That's low for your typical asset allocation sort of consultation with you as an individual client. Everybody's going to recommend a certain amount of bonds or private equity. It's usually these big categories like stocks, bonds, private equity, or alternatives. They call it alternatives. And, some may go, real estate or something else. And I think it depends on everybody's individual situation. I personally
would have no problem with having my money as long as I'm contributing to it regularly and over a long time. That means every paycheck, a certain amount, 10% of my paycheck or something like that. I'd have no problem putting it all in an S&P 500 index fund.
I don't want to make this a political podcast. I know it's election season and it's almost impossible to ignore some of what's been going on politically and how it affects your money. And in that sense, I can apply some of what's going on in terms of politics. Really, it's if I talk about anything, it's policies. And so if I ever talk about quote unquote politics, it would be certain policies that I feel um, may help or hurt the economy. So yeah, if I ever talk about politics on this podcast, it's really um, a policy, specific policies that I think may help or hurt, and a lot of business people are writing about, quite frankly. So if there are politicians saying things that don't make sense business wise, then again, I will talk about that, and I have seen some recently in the Sacramento area here in the mayoral campaign for Sacramento. There's candidates who, in order to spur builders to build, their plan is to raise taxes on vacant land, for example, which I think is bad policy. I do believe in free markets. And when you're taxing vacant land, hoping to spur builders to build, the assumption is builders aren't building because they want to not build. And I think that's a spurious assumption because it's basic supply and demand. If the price is high enough, builders will build, as in if rents are high enough or if the resale value is high enough, that justifies paying for the materials, the labor, and the building costs. Most builders are in it to make a profit, and they have to see a good enough margin to justify the investment. So by taxing, it doesn't help increase prices. It doesn't help increase rents. It artificially creates a more expensive building process. And I think that will actually discourage builders from building even more. Or with people who own current land, if it's too burdensome of a tax, for example, they have to sell. Or let's just say they're forced to build, they're going to incur losses, or it will take them longer to achieve the level of profits they need. And the assumption that they're just holding this land because they want to, and then the justification is that it's a blight to the neighborhood, it's not getting maintained, I think again is spurious because they call it carrying costs to holding land. You still have to pay taxes on land. You still have to keep it clean. If they're not keeping it clean, then find a way to fine that particular owner and make sure they're keeping that vacant piece of land clean. I'm all for that. I'm not all for, hey, let's do something quick and easy and raise taxes. And I know it sounds popular, but I think it's bad for business. So that's just an example. And, I won't get into deep into this because most people understand that tariffs are not good for business. And I will tell you, a lot of business leaders that I've read about in their annual reports now have that as a business risk is tariffs will hurt this business or have the potential to hurt this business. And so again, it's speaking of populism, it's a way to punish, let's say, China, a competitive trading partner, to make them trade fairly. Warren Buffett has written about this a long time ago in terms of how to do fair trade with China. It wasn't a popular idea, but nowhere in it does he say, let's do tariffs. I know there's been talk about what's worked in the past, and there's talk about how globalization in fact didn't work and how the academics were wrong and how it was taught badly in school. So I would just say globalization is still real. It's very, very real. The supply chain was moved to Southeast Asia. I think what a lot of companies did was maybe diversify their supply chain. To think that we're going to tariff to the extreme and not have a trade war, I think is inaccurate. And I think it's it's something that voters need to be aware of when they go to the polls is who am I voting for in terms of am I voting for the best salesperson or am I voting for the next president? We call it in sales a hard sell. Hey, buy right now. Vote for me, vote right now. You know, it's always a rush. It's always if you don't do it, there's no tomorrow. It's a way to scare you into voting for them. It's called a hard sell. And the hard salesmen don't care what happens after the deal closes. And so you have to just be really careful in terms of is this person selling me hard and will they do a good job after they close the deal? Or am I just giving them this opportunity and they're not going to take care of me at all after the deal closes? So that's something that I'd be careful of as you're out there voting for whoever is this person really trying to sell me hard and why? You know, and you don't want to wake up the next day and be like, well, I wish I voted for somebody else. And I think as voters, we are hiring essentially. We're all hiring managers. Not all of us have run a business. Not all of it, but let's just say your family. Who would you hire to manage your family's finances? Would you hire somebody who's selling you hard and has a sketchy history? Would you vote for this person to then go and manage your family finances? If not, then why would you vote for them to manage your country's finances or your own taxes? It's not about voting for the coolest person or the best salesperson. It's really about voting for who you think will be the next best president, the most trustworthy, one with character, and one who will, at least from a business perspective, who you will trust with your life savings. It's the same thing, and so I would hold that criteria to whoever you vote for next.
I just wanted to thank everyone today. I think this is helpful for both my investors. I think it's helpful for beginning investors. I think it's helpful for people who just started their money management journey or just worried about their own finances or want to know what's new and current in the investing world, in the business world. And hopefully I've done that. And again, if you enjoyed it, I really appreciate it. And I appreciate everybody who has tuned in, who's continuing to tune in. And please remember to subscribe. Please remember to subscribe on YouTube, follow on Spotify. And thanks so much, and happy Halloween. And I hope everybody has a great day and night in the meantime.